Wealth, presented by Fidelity Investments. Here's our host, Insider Associate Editor of Insurance, Rhonda Lee.
Welcome. I'm very pleased to be your host today. Thank you so much for being here with us. And thank you to Fidelity for presenting this event. 1 out of 5 households in America has zero or negative wealth. They owe more than they own. More than 2/3 think their children will be financially worse off as adults. And most don't have money saved for their children. This is an urgent conversation, and we'd love for you to share it by using the hashtag #MasterYourMoney. Look at the dashboard at the bottom of the screen. You'll see additional resources and speaker profiles. Share questions there, and we will try to address those in our discussion. Finally, we want to know what you enjoyed about today's event and what could we be doing better. So, please take the survey by clicking on the icon at the bottom of the page. And now, I'm pleased to introduce my guest. Our first panelist is Echo Wang, founder and president of Echo Wealth Management. Echo left China at 20 years old with only $800. She is a certified public accountant as well as a certified financial planner. Our second panelist is Kelly Lannon, Vice President of Young Investors for Personal Investing, Fidelity Investments. She is passionate about helping people understand the financial considerations for debt management and investing. Everyone wants to give their kid a head start in life. Building generational wealth is an effective way to do it. There are different forms of generational wealth, and for some communities, it's harder than others to build that wealth. We can all start building wealth that will outlast us. If you are a first-generation college graduate, like me, you probably didn't hear much about investing or creating generational wealth. I learned through trial and error. Ladies, let's be clear with some basic definitions. Kelly, in 15 seconds or less, tell me what is an asset?
Okay, 15 seconds. So asset, how I would describe it is what you own. Some examples are cash, house, accounts. They are usually things that you can turn into cash. Did I make it? Was that 15 seconds, Rhonda?
Good job. Echo.
Good. Okay, just get used to the pace.
Echo, what is an asset?
Well, asset is something that has economic value and that can turn into cash flow in the future. And I think Kelly addressed it. Examples are, for example, your home, your car, your saving balance, and your portfolio value.
Thank you, Echo. And Echo, I'm going to start with you for this second question, 15 seconds or less. What is a liability?
Liability is contractual obligations that a debtor has to make future payments to a creditor. And a good example, I think examples are credit card balances, mortgage, student loan, or accounts payable.
Thank you. Kelly, what's a liability?
So if the asset is the things you own, I consider a liability the things you owe. Echo had some great examples: credit card debt, student debt, your mortgage. Your liabilities are the amounts that you often owe to others. And just throwing something on top of that, often we hear that term net worth. Often your net worth is the difference between those two, your assets minus your liabilities.
Thank you, Kelly. So Kelly, we're going to start this one off with you. What is wealth? 15 seconds or less.
Okay, wealth. So what I would consider wealth, and to be honest, I think that it can be a different measure depending on who you're talking to, but really is the total of assets. That's things that you own that give you financial security. Often I consider wealth the means to financial freedom, which could be different between myself and others.
Thank you. Echo, what is wealth?
I pretty much agree with Kelly. I think one thing to add to it is you want to increase the value of assets and want to reduce the liabilities over time because that will increase your net worth. And that's how you get started to look at those positive numbers on the asset and by reducing the negatives on the liability to increase your wealth over time.
Thank you. Okay, so Echo, You came to America with only $800, so you know something about building wealth. What are the ways people traditionally pass down generational wealth?
Good example would be, I think home ownership is a very big factor for people pass on wealth to next generation. Also, life insurance, death benefit, when people really want to have a guarantee amount to pass on wealth to the next generation. For some people, it's a business, family businesses, and very commonly seen right now for many of my clients who have built wealth is to set up trusts. Could be revocable trusts, could be irrevocable trusts that can hold either investments such as stock and bonds, or could be real estate, or could be your home, and could be family business. So those are main forms of generational wealth.
Kelly, do you want to add to the traditional ways that we see people passing down generational wealth?
Yeah, and I think before we add on to it, I do think it's important to, when we say generational wealth, like what exactly do we mean? When I think of that, I really think it's a way to boost our financial wellness so that we can ensure the financial wellness of our children and perhaps their children and their children's after that are really secure for their lifetime. So I think going back to some of your questions, Rhonda, so if the income is what you earn, wealth is what you own, generational wealth is really what you're able to pass along throughout the family line. And I think it's important that it's not just for the uber wealthy. I think sometimes the assumption, when you think of, all the famous people out there who are making millions every time they step on stage, that's what people often think. So, oh, that's wealth. But really the average American, the average individual who can make smart decisions can really help bring wealth down to the generations after them. Now, easier said to done, of course, and we'll talk about that later, but I do think it's important that when we're also thinking about generational wealth, some of the examples Echo gave were really good ones. It's not necessarily just when an individual passes away. It's not just when they, pass away and they're leaving something to their children. It's actually things that they might be passing along to their children or their relatives while they're still alive. For example, helping to pay for a college education, helping to secure a down payment on the house. Those are examples of wealth transfer that can give people leg up in terms of the lives that they're living. And so again, Echo really started on kind of the bigger ones. Home ownership is an example, wealth passed along in a trust, family business. My family owns a bunch of car dealerships. That's our family business, for example. Multiple revenue streams, the cash in your accounts. These are all examples of how one can pass down wealth from one generation to the next.
Thank you, Kelly. Echo, when we talk about obstacles to building wealth, what are the barriers to building traditional generational wealth, particularly for communities of color or first-generation college graduates?
I definitely see the main obstacles in the U.S. as that people of color have faced, I think, suffered systemic racism. And I think that is a very long-term issue. And because I think the studies show that the typical white family household has net worth is 10 times as much as African American families. So I think the wealth gap is more severe than the income inequality because, of course, the income helps to build wealth. But I think that's a main issue. And I think also for lack of access to higher education, because I think many people of color do not or cannot actually get into great universities to have professional degree. And also I think lack of financial training, maybe the family, because the parents do not teach basic financial management skills and investing skills early on. So people do not have role models to follow. That is a major obstacle, I think, for people of color. I can also think of massive student loan debt for many people right now because of the increasing cost of college education. And I see that people of color probably have higher student loan debt, and also they probably pay very high interest rate for the debt. So for them, it may take many, many years, maybe in their 40s, to actually pay off the student loan. So I do see those as a major obstacle. Another thing I can think of is also financial literacy in the U.S. I think many people did not learn that in public school education before they, go to college or go to the workforce, and they don't understand the basic knowledge of financial management, and that could get them in trouble of accumulating too much student loan. Maybe they choose a degree or a field of study that simply doesn't generate enough income to pay off $100,000 student loan. I see that as a very big issue for people to start building wealth and potentially pass on wealth to next generations.
Thank you, Echo. Kelly, we're going to follow up with you. And before we get into that, I want to follow up on something you said regarding the traditional ways to pass down wealth. You mentioned your family business. I'm going to throw out a few statistics. The Pew Research found that first-generation college graduates actually lag in income behind their peers. We had Echo mention about the racial wealth gap, in addition to the pay inequality with salaries. We also talked about how life insurance is a way to pass down wealth. However, 43% of Americans don't have life insurance. And although African Americans are the most insured, they are also underinsured, meaning that they only have enough insurance to cover funeral and burial costs. They're not passing down extra income that would help fund starting a business or something to that effect. So when you talk about your family business or giving money in a lifetime, how are those things barriers when it comes to first-generation college graduates, like you said, for putting a down payment on a home, or for communities of color who have dealt with institutional or systemic racism?
Yeah, and I think that's a great question. And again, just to add on, I think that that's where we look first, right? Is this wealth gap, whether we're talking about communities, different communities of color, whether we're talking about first generation college students. I mean, if you have less wealth to begin with, to even support your day-to-day financial wellness, how are you able to then pass along that wealth from one generation to the next? So I do think that's very important. When you don't have enough wealth, when you don't have enough income to weather even a financial emergency, such as a layoff or a family member's illness, I think the pandemic is probably the most up to date. It's still in our faces in many ways, but I think that really showed kind of the difference in inequalities that we're seeing in various communities. And to your question, Rhonda, if you are not having enough wealth right now, you can't really expect to, again, pass it along. And, I was actually reading about this, a couple weeks ago in preparation for this conversation. And I was reading an article about two individuals who, exactly the same age, college roommates. And, one individual, she was someone who, came into school. She was able to have the support of her family to help pay for her college education, didn't have to take on debt. When she graduated, she had the ability to take on an unpaid internship. That unpaid internship allowed her to get a job where she was making, let's say, like $80,000 in salary. And again, because her parents were helping to pay for her expenses during that unplanned internship, she was able to actually take on a job that was making her more money. Already her net worth, her wealth was pretty darn high. And then you compare that to someone else, her college roommate, who is a first-generation college student who had to pay their own way throughout school, had to take on student loan debt. When they graduated school, they weren't able to take that unpaid internship that could lead to a higher salary, and instead just had to take the first job that was available to them, maybe at a $50,000 salary. And so they already were at a significant disadvantage from their peer due to their circumstances. Now, I just say that because I think that sometimes those concrete examples, Rhonda, are what really help me and others really understand the difference between one individual versus another, depending on either the community they're coming from or, if they are a first-generation individual in school.
Thank you so much. Echo, we want to go a little bit deeper. You mentioned financial literacy, and before you unpack that, I saw an example. Someone mentioned on social media that their grandfather had inherited over $1 million, not only the grandfather, but also their mother and other aunts and uncles from her great-grandfather. But by the time the grandfather died, he basically died penniless, living in a trailer that he didn't own. And the person mentioned that one of the reasons why this was a problem was because the great-grandfather never shared how he managed to create such wealth, so that the next generation didn't build on it, they actually lost it. So when we talk about financial literacy, Echo, what do you mean when you say financial literacy?
I think financial literacy really means knowledge and competence of like money management concepts. So people need to understand the basic financial management skills, including budgeting, investing, how to use debt. So your example, even if you inherited many $1 million, but if you have not learned that basic skill, it's very easy to squander the money away. So I think when we talk about financial literacy, it's really important to start early to learn the basic concept. One example would be, learn about, of course, budgeting would be pay yourself first. So that has to be first in your budget versus, other items that you would love to have. So learn about needs versus want. And another important concept for people to understand is you can accumulate wealth through time by investing money, because the compound interest, the magic of compounding, works really well if you give it the time. So I think it's so important for people, when you think about wealth transfer, it's so important to learn first yourself. And also the stories, if you inherit money, it's important to learn how the wealth was created, and also understand the values that you want to pass on to the next generation. So it's not just the financial assets, it's what you want your heirs to remember and to learn, and how to be a good steward of the wealth. And I think that's really important, from the basic understanding of financial concept to maybe more sophisticated investing principles and tax strategies, and of course using insurance and estate planning concepts to pass on wealth more efficiently.
Thank you, Echo. Kelly, we're going to follow up with you. One of the things that I want you to focus on in talking about financial literacy, I remember as a first-generation college student way back when, that we were told that student loan debt was good debt. But also, when I went to college, there were limitations on how much we could borrow. Now, there was no way an undergraduate could take out 20 grand a year for school. Now they can. And so with everyone talking about the student loan debt being the next financial crisis, when it comes to financial literacy, how do they know what's good debt, what's bad debt? You're getting credit card offers straight into college. So can you talk about that financial literacy, particularly for those people who are, this is first freshman year in college, maybe they are first generation. What is financial literacy for them?
Yeah, and so I do think it does tie to what Echo already shared, but in terms of financial literacy, I see it really as helping to build the confidence, the understanding of concepts, including things like saving, investing, and of course, as you referenced, debt. To your point, there are examples of both good and bad debt. Student loan debt is often seen as an example of good debt because it is something that you have to take on in order to send yourself to college. And as you've already pointed out, Rhonda, in some of your statistics before, we have seen that those who do have a college education do end up making more than those who do not. And so I think that's often why we see that as a good debt, as a way to actually further yourself in your career, your income, your wealth when you actually get out of school. And why we look at bad debt, such as credit card debt, is that it can have a negative impact on things like your credit score, which could affect borrowing in the future. And if you can't borrow things in the future, for example, enough money to make a mortgage, you can't buy a home, and you can't earn wealth by having home ownership. And then you can't pass along your home in terms of generations after you. So it is all very much tied together. And when it comes to financial literacy, I feel like this is a topic that it needs to start early. Needs to start often. Yes, it needs to happen in the school system, which, I think only 14 states in the country actually have a requirement to teach financial education within high school. But Rhonda, I don't want to completely dismiss the story that you told about the grandfather who had all this money and then he never talked about it. So yes, while I truly am one to believe that financial literacy should be taught in the classroom, it should be part of our fundamental education, I also don't want to diminish the fact that finances, money is often taboo. We're most likely to talk about our health and our money. And I think this is an area that we need more conversations. We need to have conversations about what's coming in and what's going out, even if it's uncomfortable. I know that culturally, this isn't necessarily a topic of conversation that happens around the dinner table. You definitely brought this up. My parents, we never really talked money as well. And as a result, I didn't know what questions to ask. I didn't know a lot coming out. We talked about everything else, I think, but finances. And so I just want to make sure that we kind of intersect the commonality between financial education, financial literacy that happens in a classroom, as well as financial literacy and financial education that can happen in the day-to-day conversations with your family members, your peers, or your community at large. I understand that everyone, can talk to their parents about that, but community is a big deal. And so we want to make sure those conversations are happening as well.
Kelly, I'm going to follow up on what you said. You said talking about it in taboo subjects. Some people, you mentioned we're not talking about money. For life insurance in certain communities, particularly the African American community, is very taboo, which is why when it comes to passing down that wealth, you don't have that happen because people have only bought insurance for funeral expenses, final expense insurances. So that's one of those things where it's like, yes, we do need to have these conversations, not only in school, but also among family members. Kelly, can you explain a little bit more? You mentioned that your family had car dealerships as their family business. How then did you learn how to save money, invest money, if money was not spoken in your household?
Yeah. So I'll start with saving because, it wasn't until I actually started to work at Fidelity almost 8 years ago that I learned anything about investing. So when I was a young kid, my parents always taught me the importance of saving. It really started with my first job when I was 14. I went to a local bank branch, in my town with my mom, opened a bank account, and that was a really source of pride, right? I could get these paychecks from this club that I worked at, and it could go directly in my bank account. So from day one, I do credit my parents with always teaching me about the importance of saving. So I will say that. But in my household, we never even talked about investing. We never really talked about things like credit cards. We never talked about the stock market. I think my first kind of acquaintance with the stock market was, I think we played a game in elementary school where we played the stock market game. And I honestly think, because I loved McDonald's, I still do, which is gross, I know. But I think honestly, my first stock that I bought in this game was McDonald's, and so that was kind of my first introduction to the stock market. But honestly, Rhonda, it wasn't until I graduated school when I kind of paused. I looked around a little bit and I was like, oh my gosh, why didn't they teach me these things? Why didn't anyone teach me the importance of, building a credit score? Why didn't someone explain to me what a 401k was? So it wasn't really until I got to Fidelity where I met colleagues. I'll never forget this woman who sat next to me, this woman named Janice. She sat next to me and she kind of explained everything to me. She explained the importance of getting a match in your 401k, which is kind of like free money. She had explained the importance of me, hey, this is an account for your retirement, but if you wanted to save for a house and put your money in the stock market, you have to open this thing called a brokerage account. So it wasn't until I actually ended up working here that I was really arming myself with the education that needed to get started. And also it was very helpful once I did graduate and I started to, have bills, started to need to pay things on my own, that I had to really start to educate myself, because if I still wanted to go out on a Friday night and have fun, still wanted to pay my bills, I really had to take ownership of that.
Thank you, Kelly. Echo, I'm going to address the same question to you. What's the big difference between savings and investing? People are like, oh, I have thousands of dollars in my savings account. Why do I need to invest? And particularly for people who are just letting money sit in the bank.
Yeah, I think the most important concept to understand is magic of compounding, right? But if saving is important in order to build a portfolio in order to build enough money to invest. But the major difference is if you just save and let it sit in a bank account, the interest rate is extremely low. Let's say you get paid less than 0.5%. In order to grow your wealth, you want the return to be greater than inflation. So let's just say average inflation is like 3% over 50 years. If your money is sitting in the bank, you're getting paid less than 1%, you are actually losing, you're guaranteed to lose purchasing power over time. It's a very dangerous thing to feel safe, but actually not growing your wealth. So I think major difference is if you do not invest for the long term, you are giving up the opportunities that you can potentially earn more than like 5% or 6% per year compared to letting money sit in the saving or checking account just to feel safe emotionally, but that doesn't help you build wealth. So therefore, it's really important for people to have a strategy that focus on long-term return. After you have set aside enough for emergency fund that should be sitting in checking or savings account in case you lose your job or your car breaks down. But I think the major reason is to grow the money over time to outpace inflation in order to build wealth.
Okay. Echo, in practical terms, how do you start building wealth, particularly if you're a millennial, you're fresh out of college, you just started your job? How do you start to build that wealth?
I think first I want people, after you look at all these pretty upsetting statistics of, people's income hasn't grown for many years and huge student loan, but I want you to first believe in yourself that you can actually succeed if you plan ahead and you build your financial confidence through, learning, either taking a course or read books or follow blogs. And I think for a young person right away, you really should focus on the budget and pay yourself first and manage the debt. Of course, try to reduce the high interest rate debt first. At work, make sure you put in enough to get 100% of the matching in the 401k plan, because there's nothing else in the world that almost guarantee 100% rate of return with very minimal risk. Because a lot of companies match 50% up to 6% of your income. So if you are 22-year-old, even if you put $100 a month in there per month, over time, it could be a very significant amount. And also, if you are able to save more before you have children and mortgage, it's going to give you more flexibility someday when you start a family. So I would say start early. And of course, if you are able to save more, consider looking into a Roth IRA on the side after you get the 100% matching in the 401k. Another idea for younger people just starting out is when you build a budget, have that investing to be more automated, systematic. It's a lot harder to save if you have to constantly ask yourself how much I should be saving this week or this month. I'd rather have a plan to pay down the debt, how much needs to go in towards debt, but then also have that minimum saving to match the 401k, and also go into an investment account that's out of sight, out of mind, and then just keep long-term perspective and let it grow.
Okay, Kelly, I'm going to follow up with you. If you're fresh out of college, new job, how do you start building generational wealth?
Yeah, and so I'm just going to kind of piggyback on what Echo said, but I'm going to just boil it down into a few steps. That always helps me to think of things, So, the first thing that I would do fresh out of college, number one, is start an emergency fund, okay? Have money set aside in case the unexpected happens, because you can't start building wealth, you can't start investing if you don't have enough aside and something happens there, all your money has to go to that. So that, in my opinion, is always step number one. And this is a perfect example example of how savings and investing can really happen at the same time. So that's step one. Step number two, if you have the opportunity to contribute to a 401k, workplace retirement account, a 403b if you're in the non-for-profit sector, definitely do that. Always take advantage of that. And as Echo said, make sure that you're putting enough into that account to get that match, okay, the employer match. It's like free money. You'd never leave free money on the table. If we send everyone listening $1,000, you wouldn't send it back to us. You would keep it, okay? So number two, always make sure you're putting enough in your account to take advantage of that match. Step number three, I would actually take a look at your debt. Rhonda, you brought this up a few times. We've talked about this. A lot of individuals, they do have to take on debt, particularly student loan debt, in order to put themselves throughout college. I often wish coming out of grad school where I had to take on loans, I didn't have loans coming out of college, that I had more education about it. I remember there was a course that you had to fill out, saying, hey, you understood all this. I didn't understand anything. And it wasn't until 3 months later when I had to start paying off my debt that I was like, oh my gosh, I have no idea what I'm doing. So step number three would be make sure to take the time understanding exactly what I owe and really developing a payment strategy on how I can start to build down that debt. And then step number 4 and 5, if I was thinking of this in a step-by-step process, is I would always try to contribute a little bit more to my 401k if I can. What we've seen, and we're seeing it right now, is that historically the stock market is, I think generating over the past 20 years about a 10% rate of return, which is much higher than some of that lower interest debt that sometimes you take on, not student debt. And so I'd always put a little bit more towards my investing. And like I said, and like we kind of all talked about, the earlier you get started, the sooner you can start building wealth. But if you're also on this call and you're not right out of college, you're in your late 20s, early 30s, early 40s, however old you are, it is never too late to get started. I think sometimes people think, oh, well, I've already missed the boat on this. It's too late for me to start building wealth. It absolutely is not. So make sure you get started, you get your head in the game. And if you have questions about anything I just said, because I'm sure you already do, make sure you reach out for help. Come to folks like myself, like Echo, go to people in your lives, in your community that can help you. Never be afraid to ask questions on these topics, because I guarantee you, everyone else around you probably has the same question. I was always nervous that I was, gonna sound like dumb or stupid by asking questions. And it turns out by asking those questions, by vocalizing them, a lot of other people around me had the same questions, and then we could end up all helping each other.
Okay, before we go into audience questions, I'm gonna follow up on that question, on the whole thing about how do you start. You mentioned talking to people, and Echo, I'm going to start with you. But before we get there, one of the things that we always talk about is building a team. And like I said, for our audience members who are not fresh out of college, maybe, they did not maximize their 401k when they were in their 20s and 30s, and now they're in their 40s, and, they're starting to look more towards retirement. What could they be doing? What steps? Are there things to help? Like, what's this thing about a robo-advisor? Do I really need to talk to an accountant? Do I need a financial advisor? How are they going to help me? And, what's the whole point of having an estate planner? So, Echo, can you go into what it looks like and how those people can help?
Yes, absolutely. And it's so important for me to emphasize on, of course, the principle, right? You got to start early. But if you didn't start when you were much younger, it's so important to start right now versus just kind of ignoring, all these problems. I think for people, especially for people in their, let's say, 30s, 40s, or 50s, they are extremely busy, and especially with their kids and demanding career. And it takes a lot to learn about the complexity of financial market. I want people to understand that it's much easier for you to go and find a trusted financial advisor, planner, to help you, to guide you through the process. And if you look for a financial advisor, you can expect the person to understand your financial goals and help you define short-term, intermediate, or long-term goals in measurable terms, and also explains an investing concept and principle. And a good financial advisor can also help you manage emotions to avoid costly mistakes during market downturn. I think that is one thing I want people to understand, that yes, not everybody maybe right away immediately work with financial advisor, but they still need to have some basic plan of saving, paying down the debt, and investing. And let's say if they decided to go with robo-advisor, meaning that that's more electronic on the internet, that in general, you know, ask, they will help you do the basic calculation of how much you need to save, how much you need to invest. But if you at least get you started. But when you are at a point where you prefer the personal human touch, especially you want to communicate with someone who understands you, to create a personalized financial plan, that is the right time to go and interview a person. You can go online, and there is a website called letsmakeaplan.org. So there is a planner search function where you can search for the financial planner and interview them, and they are certified financial planner, you know, with proper training. And when the team, talking about assembling team, in my book, Own Your Future, I have entire chapter about how we identify, assemble a financial dream team. I start with the first person would be financial planner. We also call it financial advisor. And that person may be able to introduce you to other financial team members. Estate attorney is really important because, especially during pandemic right now, many people do not have a will, financial power of attorney, and healthcare directive. Those are really important legal documents that if you work with a estate attorney, you can get it done properly. Potentially, you want to set up a revocable trust to avoid probate if you have a significant amount of money. And insurance agent, you could be a very valuable team member to review proper life insurance, disability insurance. You may consider long-term care insurance as well. Tax CPA. I used to be a tax CPA in the 90s, and I can see a very important relationship with tax CPA to help you reduce taxes now and ongoing. Banker is another important member of this financial dream team. Make sure that
Thank you, Echo.
they work together.
I wanted to get to some of our audience questions. Kelly, one of the questions from our audience is, when you're building generational wealth, how do you hedge against inflation and taxes?
Yeah, so I think one of the best things, especially when it comes to taxes, because this is an area I continually ask questions about. I think when it comes to taxes, especially when you're thinking about passing on generational wealth, this is often one of the first topic areas that most people bring up. My biggest piece of advice, unless of course you're a CPA like Echo was in the 90s, is make sure you're asking for help. Make sure you are speaking to someone who has some experience in dealing with taxes. I think that is probably my best piece of advice, because this is an area, especially when you're passing along money from one generation to another, everyone wants to make sure they are getting the most advantage to their taxes as possible. So that would be number one. I think number two, in terms of the inflation question, we talked upon this a few times. If you're simply keeping everything in cash, if you're not actually putting your money to work for you in the stock market, you will never ever keep up with inflation. And just so other people listening are like, wait, what's inflation again? You know, what that means is that things today will not cost the same in the future, just like things today don't cost the same with our parents and grandparents growing up. So if you're just keeping everything in cash, you very much run the risk of not keeping up with inflation, because as inflation rises and everything's in cash and the returns are really small, you won't be able to afford the house that costs $200,000 today, because it'll be $300,000 10 years from now. So that's why it's very important to get started with both investing in addition to saving and putting your money to work for you harder.
Thank you, Kelly. Echo, I want to follow up on something that you mentioned before when it talked about financial advisors and financial planners. One thing that I know is an issue, particularly when it comes to communities of color, it's trust. And we hear about representation matters. And unfortunately, the history has been that a lot of times, you know, you don't see financial planners and advisors of colors. I know when I came out of college, most of the time when I met financial advisors, they were white men, and they were just like, just give me your money and I'll invest it. And I'm like, I don't know you. You sound like a salesman to me. I don't trust you. For people who are concerned about finding a financial planner or a financial advisor, a person of color that knows or understands and has cultural sensitivity about the community, where do they find a financial planner or advisor of color? I think the whole financial advisor relationship is kind of like finding a personal trainer, because if I don't trust you, I'm not going to follow your advice. So Echo, where do you suggest for people who have that trust issue? And like I said, it took me years before I found a financial advisor that I actually trusted.
Yeah, I totally understand your the issue right now, because when I got into the industry 21 years ago, I remember only 23% of the CFP, Certified Financial Planner professionals, were women. And now, 21 years later, still 23% women. So, and of course, people of color normally do not get into this field. And I am working really hard to increase diversity in this profession, to attract more people into this profession, and to tell my story as well. For those people who are looking for help, I believe it's important to understand the training and also how financial advisors get paid. And there are also two different standards as well in how, some financial advisors do not really need to follow much higher standard. What we consider is fiduciary standard versus suitability standard. So fiduciary standard requires the financial advisor to look out for the best interest of client. So it's ahead of herself, himself, or head of the firm. And in general, if you look for the firm, what I mean by CFP professionals are required to follow that standard. And many firms in the industry have adopted the higher fiduciary standard. What that means is very clearly spelled out how you get paid. Do you get paid by do you get paid hourly, or do you get paid based on the asset balance? Or do you get paid commission from the products you sell? So it's really important to understand that, and of course, do some background check, meaning that you can go on, read all the disclosures, and of course, go to Financial Planning Association and ask for referrals as well. It's important to check on make sure that person has proper training. I think the competency is important for you to trust that person, understanding how they get paid. And another thing I want to mention is personality match. Just like when you're looking for a family doctor, let's say 3 of them, they are all board certified and qualified. You want to find someone you feel comfortable and you can feel comfortable talking about your money story and do not feel shamed or fearful to bring that up. So I think it's a process people should go through sooner. I'm just saying start now by just using different resources I mentioned, and also ask for referrals and request a few interviews to choose the one you can trust and you feel most comfortable working with for the long term.
Thank you, Echo.
So it's like dating, right? To put in probably a lot of nervous and misunderstanding. Let's be real about it, right? Yeah, think about the standards you hold yourself to in a partner. Hold yourself to that same standard with whoever you're going for, in terms of financial advice. It's your money after all, and money touches everything. So
thank you. Kelly, I have a question for you. It's from the audience. It says, with life insurance, would you recommend a whole life or a term life policy? And before, Kelly, you answer, I'm the associate editor of insurance, so I have to just put this out here for our audience. When people say whole life, a lot of times whole life is used synonymously with permanent life. When whole life is a permanent life insurance product, they're very different types of permanent life insurance products. They all have cash value. So I just want to put that out there. Now, Kelly, you can go into, should I get permanent life, which includes whole life, or should I get term life?
I mean, to be completely honest, I am not an insurance expert, and Rhonda, you sound like you are. So I might actually throw the question back to you. What I will say is that the very essence of wealth protection, financial protection, is insurance. Echo talked about a doctor. You need insurance, for your health as well. So I think that regardless of what you choose, because it is a personal decision, make sure you have insurance. So Rhonda, if you don't mind, I mean, you know far more than me, so I'm going to throw it back to you to help answer that question, if that's okay. I know you weren't prepared for that, so.
It's okay. I'm supposed to know this answer. So this is what I would recommend to anyone. The first thing is understanding that term life lasts for a certain time. 5 years, 10 years, 15 years, 20 years, 30 years. After that term is over, you have to reapply for insurance. It's cheaper because it only lasts for a certain period of time. Permanent life insurance lasts your lifetime. In addition to having a death benefit, you also earn what's called cash value. The difference between whole life, universal, variable, and other permanent life insurance products is how they earn their cash value, either from the insurance portfolio or from the stock market. One of the things that I tell people, you should get a life insurance policy that fits your financial budget and your needs. I had someone come to me and say, hey, Rhonda, what are you doing? But this person had dependents. I don't. So my financial plan shouldn't look like yours. So I would say you want to start off with some type of insurance. Most people start with term life and then they convert it over. However, as Echo and Kelly said, it should be based on your financial situation and your financial plan, which is why you want to engage a financial advisor or a counselor. If you're like, I don't know if I can afford that, start with your bank or credit union. Most banks and credit unions have financial advising counseling services. You put your money in that bank, put them to use. Next question. How can we build wealth from a regular job? Echo.
Well, as I mentioned earlier, your regular job means you have a steady earned income coming to you. So start with a budget of paying yourself first to put in a 401k and reduce debt. And in fact, what I was thinking is, in addition to earning your income from your current job, remember to invest in yourself to learn additional skills as well. I think when people think about, oh, I just have a regular job, I'm not going to make $1 million. But what people forget is we don't become millionaire overnight unless you inherit money. So myself, I started with almost nothing. But what I have learned is at my first job, maximize 401k. And then over time, I learned new skills and I decided to learn about financial investing and got another certification and then changed my career. Or you could have another side business or, that follows your passion. In the future, you may turn that hobby into a business. And so I think even regular job, I don't want people to feel that they cannot accumulate wealth. In fact, more than 90% of my clients I'm working with right now are people, first generation wealth creators. They have accumulated wealth over 30 years to several $1 million, and that's actually possible. So I do want people to invest in themselves. And also another thing is health and wealth go together. So if you invest in your own health, potentially you will reduce your medical bills. And also because you are healthy, you are able to work longer. As we expect to live longer, we want to be able to actually look at retirement planning very differently. It's not the traditional way you just retire and you don't work anymore. And think of it, especially for the people who started late. If you haven't started until you are 35 or 40, you need a personalized plan to address. Maybe you can continue working if you love your job, and you can work part-time over, 60 or 70 years old is totally okay. So that's just something I want people to think about. It's not the traditional retirement planning. It's more about planning for the financial independence day, that you can make work optional and live a very healthy life in the long term.
Thank you, Echo. And one thing that I would add to people is, it is not so much about if I just win the lottery or if I just hit it big in Vegas, then I'll be wealthy. If you did not have good money management or financial literacy skills before you hit the lottery or make it big in Vegas, that's not going to help you now, because about 90% of the people who win the lottery within 2 years are bankrupt. So just keep that in mind. It's about having that budget worksheet, and the more money you start to get, engaging other people like a financial planner and an accountant. And that sets me up to the next question for Kelly. Are there tax favored assets to help set up generational wealth?
Yeah, I'm still marinating on that stat about the lottery. I didn't know that. Make sure not to necessarily buy a ticket this week. So, yes, so that there are a lot of different tax advantage assets. We've talked about this one a lot, and that is a 401k, where you're actually not paying taxes on the money going into this account, and it reduces your taxable income, at the end of the year around tax time. And it's only when you're actually taking the money out that you pay taxes on that account. And so that's one example. We've also talked a lot about and assuming the fact that a lot of people have access to, a workplace retirement plan through their employer. If you don't, that's also fine too. There's still ways to save for things like your retirement. And so we've talked about two accounts already today: a traditional IRA, which functions in very similar to a 401k, meaning you don't pay taxes on any money coming in. It grows tax-free year over year, and it's only when you take it out. But there's also something called a Roth IRA, where you actually pay the money on the taxes up front. And if you're at a lower income bracket to start, which most of us are, because you've already paid the taxes, when you go and take it out at retirement time, and hopefully you all are millionaires by then, since you've already paid the taxes, you don't have to pay them again. So these are just three accounts, specifically retirement accounts, that are important, and tax advantage accounts that you can look into. I know Echo also referenced your health. There's something called a health savings account, which is an awesome account as well. This is an example of an account that can go towards health-related expenses, and this is actually triple tax-free. So that's an account to look into. Echo, you've also mentioned a family. I just had a kid about 3 months ago. The day I got her Social Security card, I opened up a 529 account for her to pay for her education. Again, a tax advantage account that can help my kid hopefully get educated in the future. So these are just a few examples of accounts out there that really have tax benefits to help each and every person on this call today save for the things in your life that you want, whether that's health related, your retirement, or if you just had a child.
Okay, so I will also piggyback on Kelly towards tax benefits. One of the big differences between term life and permanent life is that when you have permanent life, the money is tax deferred. Another reason to talk to a financial advisor and an accountant. Many people who use permanent life insurance are extremely high net worth individuals because the money is tax deferred and you don't have that problem. So that's another thing that you can look at. But again, talk to a trusted financial advisor before doing that. Echo, I'm going to direct this question.
Hey, Rhonda, can I just pause for 1 second?
Yes, Kelly.
I just want to point out, because I know if I was listening right now, we've said a lot, turn to a financial advisor. I know when I was younger, I would have felt very intimidated by that statement. And so I just want to point out, if that feels scary, it definitely shouldn't. And we've kind of talked about that a little bit. There's definitely individuals that hopefully you can turn to in your communities. The other option too is we've talked a lot about that workplace retirement account. That's also a really good place to start. Rhonda, you brought that example with your bank, going to the people that you already have a relationship with. Same with your workplace retirement account. There's specific plan sponsors that are there to support you for all of your needs. And often a lot of these plan sponsors, they don't just handle your retirement, but they handle your overall financial wellness. I know that's something we do at Fidelity. So that's also a really good place to start. If it's really sounds scary right now, I have to go find a financial advisor right away. So just giving everyone listening to this call some other options on the first people they can talk to.
Thank you, Kelly. So Echo, this question is from the audience, but I'm going to direct it to you because you just have a book come out. Can you recommend a good book on financial literacy for an adult or teenager?
Wow. So in addition to my own book, Own Your Future, one woman's story of story of immigration and financial freedom that came out last year during pandemic. You can find that on Amazon. Another book that made a big difference on my own life is The Millionaire Next Door. I think that is a book I read actually before I changed my career, and it's a great way for people to learn that how you can become a millionaire, and many millionaires do not look like millionaires. And then I also would like people, go on the website. Right now I have, so echohuang.com, I have a blog, and I want to educate more people about financial planning, even though I cannot serve them as their financial advisor. And I have articles out there and to educate. Well, my daughter is 16 years old, so a very good example when I try to teach her about money management skills, and I continue to contribute that on the blog. And I would say, in terms of other books, yesterday I did some research about financial literacy standard in the U.S., and there is actually if you Google it, financial literacy standards, I think the most recent version is 2017. And it lists all these financial concepts people should know at 8th grade or 12th grade. So I think it's probably not a bad start for people to just Google financial literacy standards, maybe 2015 or 2017 version, and download that. And I think that will at least get something started for what kind of important concept you need to know before you become a young adult.
Thank you so much for that. And also for our audience, the FDIC has a smart money website that it's free. You can download and take those classes. Ladies, what I've been hearing from both of you is building wealth is like weight loss. It doesn't happen overnight. It starts with a plan and building a team that includes a financial advisor, an accountant, and an attorney. Persistence is key, and constantly revisiting the plan. Start investing using a robo-advisor like Fidelity Go that has low fees and no minimum requirements. Thank you to our panelists, Echo and Kelly, and thank you to our sponsor, Fidelity. A big thank you to you, our audience, for tuning in. I hope you were inspired by the conversation on how to master your money. Remember to share using the hashtag #MasterYourMoney. In a few moments, our survey will pop up on your screen. We'd love to hear your feedback. Thank you all for joining. Goodbye.